Good morning and welcome to the show. Just half an hour away from the opening bell in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm Ingles and Stephen Engle. As you can see, our top stories today. The Bank of Korea delivering an unexpected rate cuts back-to-back their move following its policy pivot last month. Now, Asian stocks are struggling for direction while bond yields slip ahead of a U.S. holiday. Of course, the fresh economic data giving support to the Fed's cautious stance on interest rate cuts. And Chinese autonomous driving startup Pony AI slides more than 7% in its debut in New York. We'll speak this hour with the founder and CEO, James Peng. All right, we'll get you straight to breaking news right now. In the market reaction that we are seeing so far, this is just fresh out of the oven, a couple of minutes old. The Bank of Korea following up with its key interest rate cut. We're now down to 3%. Largely unexpected, and certainly when you look at the market reaction, particularly when bond futures at these levels at about 119, trading at the highest in about 2 years or so, certainly underscoring that while the direction of travel was expected, the timing was not so much. We weren't expecting that to come today. That being said, we'll talk more about this in a moment. Here, Asia X China going into the open today. And keep in mind, of course, there's also the separate story and speculation in China that led to that massive rally we had in the afternoon session yesterday into the overnight session of the Golden Dragon Index, which we'll show you in a moment there. In fact, just on that very note, right, so the likes of BYD, Kingsoft, Agora were some of the big moves overnight. BYD, of course, on the back of that report that we had that suggests that they're talking to their suppliers, not really talking, but telling them to expect a 10% price cut next year, that the price war will continue going into 2025. Golden Dragon Index up overnight, bucking the overall trend, weakness across global markets. We talked about some of these big movers. Kingsoft Cloud, again, rebounding 18%. We were, of course, speaking with them yesterday. And just very quickly, the approach to the open today, 27 minutes away. Futures, two futures. You have this rally in iron ore prices, which I believe is now up to 4 straight days. And, of course, the renminbi fix of the day is going to be very much in focus today, Steve, amidst this melt-up in the dollar, Steve. Yeah, that's right. And look what we're seeing with the Korean won, obviously, following this Bank of Korea surprise move. I mean, this is interesting because after, of course, not cutting in 4 years, last month they cut, and now back-to-back. And generally, the Bank of Korea doesn't like to do back-to-back interest rate cuts unless there's an economic crisis. Well, they must be seeing a sense of urgency given the brooding headwinds, of course, in the global economy coming up in an export-dependent economy. Yeah, and certainly. And I think this time in the next hour of the China Show, Jason Peng out of JPMorgan will be joining us, in fact. So one of his calls really there was he's long Korea rates, he's long Malaysia, he's long Thailand, he's long CGBs, because he thinks there will be an offset like what we got right now out of the Bank of Korea. So we'll get more on that in a moment. Expect more from the statement out of the Bank of Korea in about 30 minutes from now, and of course in the next hour will be the briefing out of the Bank of Korea governor. Now, that takes us into the China story today, and maybe we're waiting for the offset, right? Investors are waiting for the offset. Yeah. There was speculation it might come initially in the form of an earlier Central Economic Work Conference. I think Min will talk more about this later on, but it was a screenshot, Steve, wasn't it, that really sparked this rally yesterday in equity markets in China? Sure, and we can't corroborate that, obviously. Yeah, unverified one. Yeah, unverified, essentially saying that the Central Economic Work Conference, which is usually held in December, and it probably will be held in December, maybe earlier than expected. I guess the November ends tomorrow, doesn't it, essentially? So, yes, it might come a little bit earlier, and it might, given what we just saw with the Bank of Korea, obviously, they are trying to get ahead of things. Will there be stimulus coming from the Chinese authorities as well to ward off any kind of headwinds that the Chinese economy, further headwinds that the Chinese economy may absolutely. Face and the stocks were pushing lower recently, right? And I think Steve's point there too was really markets are infatuated with speculation right now. They're waiting for the next thing to be announced. And I think just on that graphic we just showed you before we talk about the Fed and inflation, we have 2 briefings out of Beijing today, the Commerce Ministry and also the Foreign Ministry separately taking place in the afternoon. Oh, yeah, and we have a third runway now, started today in Hong Kong, which is, I guess, non-market related, but anyway. Oh, and I heard Cathay Pacific yesterday as a side note, said by January we're actually going to get, they'll be back to pre-corona capacity as far as flights go.
The problem is foreign carriers are not coming back to the levels that we saw pre-pandemic to Hong Kong.
Oh no, so Cathy's not going to cut their prices. When have they? Anyway, 75 basis points worth of rate cuts are expected based on Fed Fund futures a couple of hours ago. So this actually includes the one that might be coming in December, then you get two or three more next year. We had an inflation print overnight, and we're still dealing with, and on the Korea story really, an EM FX complex that can't seem to catch a break. Mexican peso, the real, the Philippine peso breached 60 yesterday. Really a stronger dollar story. Let's bring in Thomas Taw, head of APAC investment strategy at BlackRock. I mean, this melts up in the U.S. dollar. How much more do you think we're going to see short term?
Well, it seems to me like we are borrowing a lot from next year's returns, not just in terms of U.S. dollar appreciation, but also in terms of U.S. equity appreciation. So there's still a lot of policy to come, right? The rhetoric is there in terms of Trump's fiscal expansion, corporate tax cuts, personal tax cuts. Those are all net inflationary and also will strengthen the U.S. dollar. But then you have, central banks like BOK actually trying to get ahead of this. So, what's the net differential going to be? I do think we'll see a little bit of a stronger U.S. dollar, but I'm not expecting exponential returns in that next year.
Is this move by the BOK, do you see as a precursor for other central banks in this part of the world, maybe also taking preemptive steps as well?
I think we can see that. I mean, certainly in China, I think that could be the case. That's more of a tariff situation than anything else. But, if you look at Taiwan, for example, I think it's a relatively similar position. Indonesia, Malaysia, all these kind of economies. The difference is that, they're coming from a much lower base level in terms of where they raised interest rates, not for all of those economies, but for a lot of those economies. So when you look at the interest rate differential that's expected next year, I still don't think we're going to get 3 rate cuts from the Fed. So, net, that's a U.S. dollar strengthener.
Has that been priced in? The fact that you think that markets are too dovish around the Fed, for example?
Well, no, because, if you look at the interest rate swaps, they are saying 3 rate cuts by the end of next year. So right. I don't think that's priced in. The difference is going to be, when we start to see these inflationary prints coming in higher, the Fed will start to look at maybe we're a 1 and done, maybe we're 2 and done, and then what's the impact on U.S. dollar? What's the impact on earnings growth?
Do you see that might cause? Will there be any, negative impact on U.S. equities, to be more specific, because if they pare back those rate cuts?
Yes, I think so. I mean, it really depends on what area of the market you're looking at. If you look at post-Trump election, where there has been a pretty big rotation trade, right, to small caps, financials, value. How long that will continue, I think that still has some legs. But as you start to move into the second half of next year and you start to see inflationary data coming in stronger, the impact from Fed rate cuts could actually impact some of those smaller companies more than the bigger companies, because the bigger companies, very simplistically, are the ones with the stronger balance sheets.
How do you see all this playing out for Japan? Obviously, they're sort of pausing on their rate hikes, but we're also seeing, of course, the yen did strengthen overnight. It's still pretty weak, though, at 151.
Yeah. In terms of yen, BOJ, I mean, and Japanese equities, I think there's a couple of things here. One is the macro side of it, right? We are seeing inflation returning to some extent, but key to this is the wage growth, right? Wage growth is super important for the BOJ and for the Japanese economy. You have the domestic side of things, where there's still a lot of money sitting on the sidelines waiting to be invested. It takes time, right, for this to filter through into the investor mindset of, we can no longer sit in cash because inflation's going up. Here are equities. They look pretty good in Japan. We're seeing increased dividends, buybacks, et cetera. And then you have the BOJ moving in the opposite direction of pretty much every other central bank. That creates a lot of diversification for owning Japanese equities in the portfolio. So, I think 2025 will still be a very good year for Japan.
What's the best Japan-specific strategy then?
So, I think what's happened in Japan is 2023, the first half of this year, it's basically, just buy any Japan beta exposure, right? And we saw that up until May of this year, and then we saw huge outflows from Japan exposure ETFs. And I think what happens now is, that was driven by structural reform, but no one actually knows what the impact is going to be. Now I think it's a much more active market, so we're looking more at active type of funds. Obviously, Japan is being driven more by value dividend type of exposures, less by growth. And that's one of the reasons why it's a nice diversifier in portfolios. So I think Japan is more of an active market at this point.
All right. We'll have more with Thomas Ta in a moment. We'll bring you straight now to Mark Cranfield, who's with us in Singapore, to talk us through the breaking news we had in the last few minutes or so. This unexpected rate cut, Mark, out of the central bank there. And in many ways, one could look at this, Mark, as an insurance cut. Ironically enough, the BOK might be telling us things are not going to be okay. Mark.
Well, they're citing lower inflation and lower growth for next year. But I think traders looking at this will think there's definitely an element of Donald Trump preemptive work in here. Most Asian central banks will obviously be concerned that they don't really know what's coming next year. They think the trade situation globally is going to get more difficult for everybody, and Asia is obviously very exposed. Anything negative that happens to China will have spillovers to the rest of Asia. So it wouldn't be surprising if there are other Asian central banks having a very similar thoughts to the Bank of Korea, is that we may need to help our economies in advance of what could be coming down the pipe next year. So it was a surprise in the sense that only 4 analysts were looking for this rate cut. Very few of the people surveyed. And yet, when you think about what's coming and the conditions, maybe there's going to be a few other people who will take a similar view. They're willing to let their currencies take a bit of a hit because they know the dollar's going to stay strong for a relatively long time. And there's not much they can do about that. The dollar will turn when the United States themselves think the time is right, more than the rest of the world. So in the meantime, they're just preparing themselves for what could be a pretty tough year next year.
Yeah, Mark, obviously the BOK doesn't work in a vacuum. So to your point about other central banks, which one do we need on the calendar? Which one do we need to circle and say we need to readjust our expectations that perhaps more cuts faster and more frequent are coming?
Well, certainly everybody in Asia, apart from the Bank of Japan, who are going their own sweet way, they still look as though they want to raise rates, and possibly even next month as well. But you've got to think about everybody, and especially those where the currencies play a huge role. So South Asia in particular, anybody in the South Asian region is usually willing to allow their currencies to take a bit of flexibility. And that would mean they would have room to lower interest rates a touch there. But yeah, every single Asian central bank meeting for the next 6 months at least, I would think, is a live meeting now. Nobody can discount the fact that you might get some preemptive easings from anybody in Asia now.
All right, MLive strategist Mark Cranfield in Singapore. We'll be coming back to you often, I think, as you just alluded to. Still ahead on the China show, BofA Securities will be with us to talk China markets and why they're cautious about the next few months. Plus, we'll be speaking with Pony AI's co-founder after shares slipped on their U.S. trading debut. And in the next hour, JPMorgan Asset Management joins us as we assess the risks from Donald Trump's tariff threats. And we are counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. This, of course, is the China show.
Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate. When your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
Okay, welcome back to shows here. So the strong dollar, this unexpected rate cut out of the Bank of Korea, your midpoint of the day is out now out of the PBOC. We're looking at a reference rate of 7.1894. I think it's worth just mentioning before we talk about the Microsoft story that yesterday in the afternoon session, equities rallied quite hard, expecting that we may get an earlier Central Economic Work Conference, and the range on the onshore rate when it traded yesterday was actually the widest in about 2 or 3 weeks. So watch when that opens up in about 14 minutes from now, Steve.
All right, Dave. Well, Bloomberg has learned that the U.S. Federal Trade Commission, or the FTC, has opened an antitrust investigation into Microsoft. We're told they're drilling into everything from the company's cloud computing and software licensing businesses to cybersecurity offerings and AI products. Bloomberg's Seattle bureau chief Anna Edgerton is with us. So, Anna, I mean, Microsoft is no stranger to past regulatory investigations. How is this different, and how serious is it for MSFT?
Well, the technology industry, of course, has changed a lot since the late 90s when Microsoft was under investigation previously. And Microsoft itself is very different. We have more details about what this investigative demand includes. And we know that the Federal Trade Commission is looking at Microsoft's cloud computing business, their software, and the way these things are bundled together. There are a lot of complaints from competitors that it's really hard for a company like Slack or Zoom to compete with the way that Microsoft bundles products like Teams in its other software. So we anticipate the Federal Trade Commission to seek more details about these programs and try to figure out whether or not that's illegal behavior on Microsoft's part.
What's next here, Anna?
Well, Microsoft will have to respond to this investigative demand. It's kind of like a civil subpoena in some ways, and then the Federal Trade Commission will take that and try to build a case, or decide that they don't have enough evidence to take a case forward. We will have a change of administration here in a few months, and it'll be interesting to see how the next administration continues this case and how the Federal Trade Commission positions itself against some of these big tech targets that we've seen it take up in the past.
Anna, thank you so much for staying up for us. Anna Edgerton there, our Seattle bureau chief, on the latest here on Microsoft. It really takes us into the broader U.S. tech story with the pullback in big tech, of course, overnight. Still joining us here on set is Thomas Taw, head of APAC investment strategy at BlackRock. It's the time of the year when we're getting these sell-side projections on the S&P, 6,500, 7,000. How much credence do you think we should be putting on these targets?
You're going to get me in trouble on that one. I would say
it's the cleanest read right now in equity markets. The cleanest place, still U.S. equities?
It seems like that, but okay. The overweight U.S. equity call is consensus, as you were just alluding to. And the question of, is there any alternative to U.S. equities? I think on the fixed income side, things are a little bit easier in terms of asset allocation because short duration seems to make a lot of sense, maybe mid duration. Yep. I think that the issue we've seen a lot of inflows into longer duration and the expectation that we're going to get a lot of rate cuts, and we might see that rotate. On the equity side, we have seen a pretty big move back into U.S. equities since September. But now it's the rotation trade. So, how long could that last? Because investors are essentially reaching into next year with the expectation that earnings growth is going to be outside of the mega cap 7. So, will that actually come through? We don't know. There's a lot of uncertainty around policy as well next year. And the final thing is, a lot of the quote unquote bad stuff can happen quite early in terms of tariffs, labor deportation, et cetera. The quote unquote good stuff is later in terms of corporate tax cuts, et cetera. So managing that balance is going to be difficult. But I think, the valuation situation is a slight concern, but for the moment, it is very much a U.S. equity-driven strategy.
Is there enough visibility down that runway into next year for confidence in rotating out of the Mag 7 into other areas?
No, I don't think so. I think this is more of a short-term tactical trade. I mean, the U.S. data has been relatively good. We are seeing this widening out, this breadth, but we are kind of priced for, I don't want to say perfection, but it does seem like if you look at 14.5%, 15% earnings growth projections for S&P 500 and S&P 500X, the big 7, that's quite a big number. So a lot can happen by then.
I want to ask you about India too. So we've talked about Japan, to a lesser extent China. India, what happens to the India story next year?
Yeah, I keep it very simple when it comes to India, China, and Japan. I basically say short term the trade is China, medium term the trade is Japan, and long term the trade is India. I think there is still some froth to come out of the market in India, but if you think about it on a very simple asset allocation level, investors still want the growth in India. So we need to see valuations come down a little bit. We have seen a little bit of rotation out of Indian equities back into China because the China underweight was really funding the India overweight. So we've seen that rotation, and I think China will continue to be a trading market. I think the only play there really is to be neutral at the moment because there's so much uncertainty and it's so volatile. But India is still the longer-term structural growth driver. I just think in the short term, you might see a little bit more froth coming out of that market.
China played through Hong Kong, or are we talking onshore?
I think the difference with this China equity rally, and we have seen a lot of them, right, over the last 20 years, I think the difference with this one is it's more onshore driven. Whereas before it was like, we're short the ADRs, we're short Hang Seng Tech, et cetera. You see the short squeeze offshore outperforms. Now it's, okay, policy is very much being delivered towards domestic. We need to get consumption up. This is more of an onshore market story.
Thomas Todd, for Roads Don't Cross Again, happy holidays to you, sir. Have a great one. Thomas Todd, the head of APAC Investment Strategy at BlackRock. Going into the open today, we're looking at declines here and a paring back really of that rally from yesterday. 0.25% down on the Hang Seng Index. The FIX coming in stronger again out of the PBOC, maintaining, and the headline is maintaining support there for the Chinese currency. The Thursday session under 8 minutes away. You're watching The China Show. Right, welcome back. Just to recap the breaking news in the last half hour or so. And the Bank of Korea delivering an unexpected rate cut. Only 4 out of the larger pool of economists did expect the move to come today, which they did. And I think in a couple of minutes we'll be getting more from that statement out of the Bank of Korea. In the meantime, of course, the market reaction has been what one would expect from a dovish move. Stocks up, the currency's down, bonds are bid substantially, 0.5%. So Korea bond futures are not trading at the highest here in, I think, 2 years or so, Steve.
Yeah, this has taken us all by surprise. Only 4 of the economists surveyed by Bloomberg expected any kind of move today. Most of them were expecting to hold pat. So it upends the apple cart. We're going to have to adjust to that. And as Mark Cranfield earlier said, look, every central bank meeting in the next 6 months in Asia Pacific are live.
Yeah. On the back of really the prospect of the tariff threats ahead, and I think in Korea's case as well, they are very open-ended economy, right? So it's, I think one of the economists that we had on the show in the earlier shows mentioned that now is not the time to focus on financial stability. And if you cut rates, that might meddle that horse a little bit, but it's really worrying about future growth.
Absolutely. And again, this is an export-driven economy. There's some signs, obviously, of CPI easing. Also, of course, housing softness. So there's some domestic issues, but it's that external potential shock coming from an agnostic as far as when it comes to tariffs, Trump administration. They will put tariffs probably on anyone, not allies as well as adversaries.
Absolutely. Going into the open, today we're looking at 0.25% to the downside, some strength coming through in the dollar, largely speaking. More in the market story, and the open is just ahead. This is Bloomberg. Welcome back and good morning to all viewers joining us from across the Asia Pacific. If you're joining us out of, the U.S., well, first off, happy Thanksgiving, of course. We're going into that part of the year. A couple of things to tell you about as we go into the session today. So this meltdown in yields, in Treasury yields, really boosting the Japanese yen. That's number one. Number two, EMFX continues to be under pressure. So things like currencies like the Philippine peso, which crossed 60 for the first time past tense yesterday. One to watch, you have the Brazilian real, of course, which is at a record low. The rupee is very close to that. And giving us something to talk about today is the Korean won, which is down against just about everything following that unexpected rate cut out of the Bank of Korea. We'll see how that plays out across the EM complex right now. The opening bell onshore, and keep in mind we're coming up a very strong rally in the afternoon session yesterday on speculation that Central Economic Work Conference may be getting shifted earlier than usual. Anyway, it's the time of the year anyway that we should be getting that meeting, which is typically in the early part of December. The other bit, too, as we change things up and as you look at a 10-year yield, have a look at Hong Kong Open, is also potentially, given the speculation out there, a higher fiscal deficit to work with as far as the budget and the fiscal pushes next year is concerned. We are paring back the gains yesterday, 0.7 to 1%. The big movers, of course, this one is set to report earnings, I believe, tomorrow. We have two briefings today. Getting a bit something in my throat today. Can I have some water, please, if we can? Thank you so much. We have a foreign ministry briefing. We also have a commerce ministry briefing as well. And look how that cleared up. Very quickly, a couple of movers to tell you about, too. And, of course, a stronger fixing on the currency today. So JD Health, Goldman out with some changes to their ratings across the healthcare space. So JD Health was upgraded at Goldman to buy. Price target is that. That's where we're trading right now. Alibaba Health, same brokerage, are also pulling back, going the opposite way as far as the ratings go. Posidong, I believe, reports earnings today. That one actually also is a change out of Morgan Stanley, rated new overweight with that specific price target. PopMart, that's also a Bocom call, though. That's a new buy. And, of course, Meituan, we talked about that, is set to report, Steve, earnings on Friday.
Dave, take a glass of water. I will take it from here. Let's bring in Winnie Wu, China equity strategist at BofA Securities. Good morning, Winnie. Let's just talk about the China markets as it stands right now. There's obviously the geopolitical overhang since the last time we've talked, but also there's so much expectations. There's news and rumors of a screenshot saying that the Central Economic Work Conference in Beijing is going to have an earlier than expected meeting. There's going to be stimulus on the agenda. What's grabbing your attention right now?
Thank you for having me. Happy Thanksgiving. I'm actually marketing in Singapore this week, and I think a couple interesting feedback here, right? In Singapore we have sovereign funds, we have many long-term, long-only regional funds, but this time around it seems even the long-term investors' focus are more on the short term. So many people focus on next 3 to 6 months, or even next 3 to 6 weeks, what's going to happen and what are the China policy responses. And clearly, yesterday, this chatter speculation about the increased fiscal stimulus is making investors excited again. However, I think generally there are some increasing concerns or frustrations regarding the China policy response. And I think some investors say, we've been buying into the news, buying into the speculation and sell on the fact. And that seems to be the pattern. And I think there's some feedback about, the policy stimulus so far very much still focus on, the local governments or potentially the banks, but not enough has been done in terms of helping out the real economy, the private sector companies, and on the consumer side.
Winnie, David here. So my guess is based on your tone, nothing much has changed, although maybe the opportunities, to your point, on our short-term and tactical trades. What are some of the best opportunities right now, given the recent pullback, particularly in Hong Kong?
Yeah, I would say from a 3 to 6 months perspective, things might need to go worse before it goes better, right? Because I still think, for China, it's probably a responsive strategy in terms of they need to see what is the new Trump administration going to do. What's the policy focus? Is that focusing on tariffs? Is that focusing on technology decoupling? Or is that focusing on financial market, financial sanctions, or on the currency side? So, I think for China, they probably need to wait to they see the external policy shocks to determine the right response, how much, where are the focus, and how to execute. So unfortunately, in the next 3 to 6 months, if we look at the fundamental side, we don't get earnings until probably March next year, and I doubt the 4Q earning will be better or beating expectations. And on the external side, we'll probably see the geopolitical tensions first and the China response later, maybe in 2 sessions in March or potentially even later at July. So for the short term, we're still focusing on downside protection, other than the very short term trading on the news, selling on the facts. We think that A-share might be more resilient, defensive, whereas H-share ADRs could be more vulnerable to flow position selling, especially particularly if we hear more bad news regarding to sanctioning on, Hong Kong market or capital market targeted geopolitical tensions.
Well, on that note then, Winnie, let's drill down into technology in China in particular. What's your outlook there with, earnings have been lackluster, but there's also increased chatter, as you just alluded to as well, about sanctions or even more executive orders by the current administration in the U.S. On limiting chips, certain HBM chips into China as an added headwind for China's tech ambitions.
Yeah, interestingly, we've been hosting a number of experts to talk about these things. I think, some experts' view is that this could be seen as a major escalation, right? Because so far, the Biden administration has this small yard and high fence policy or strategy. But if they were going to put on 100 or 200 semiconductor or future AI companies onto the entity list, it could be viewed as a major escalation. And a huge expansion of the so-called small yard. So how is China going to respond to that? Whether there will be retaliation will be the key thing to watch. And then interestingly, on the capital market response perspective, when we see that kind of news, typically institutional investors, overseas investors are much more concerned, more worried, right? But on the other side, we've seen A-share, mid-small cap technology and semiconductor AI companies had a very strong rally this week because the view is, okay, this is another push to localization. So the domestic semiconductor company actually going to benefit. So we do have this very short-term disconnection between the A-share mid-small cap market performance versus the fundamentals.
Winnie, you guys put out a report, I think along the same lines we just talked about here, tariff and beyond the U.S. election impact. And the notion that we're getting from some other people, maybe not necessarily yourself, is that the second Trump White House won't be as bad on China as the first one, the trade war and everything else. Let me ask you a question that you've actually posed on your report itself. Would it be a paradigm shift? Will this one be worse than the first time around? And do any sectors stand out this time around that we should be watching out for within the Chinese equity market?
Our fear is that this time will actually be worse than the first Trump administration. So I think especially in China, onshore, some local brokers compared this to 2016 to 2020 and said, look, in those 4 years, China's economy, China's equity market was actually doing fine. And other than the initial shock in 2018, China was able to pivot and rebuild its export very quickly. But I worry that this time it could be much more severe. It's not only about trade, it's also about the competition in technology, on the capital market, even on talent, human resources. So, on the other side of the spectrum, there are concerns that are we facing a paradigm shift that, the free flow of capital, free flow of goods, free flow of talent, human resources in the past 30, 40 years, we'll be looking at, some reversal trend, and that's really concerning. So, from our perspective, we are a bit more cautious. And even in the recent discussion with the investors, when we see earlier this week, President-elect Trump talk about 10% additional tariff, China market actually didn't respond that much. So the question is that really already in the price, or is there some level of complacency that we need to be mindful of? So I would still say that, this time is different than last time, and we need to be more careful of some structural changes. From sector perspective, for the very short term, we say focus more on the domestic focus sectors. So, the banks or potentially the coal, some of telecom media services, domestic consumption services related sectors might be more resilient and less impacted by these tariff or geopolitical tensions. And then, looking 6 months out, potentially we need to look at China's policy response and by the stimulus beneficiaries. I do think, some of the large internet companies, they still have pretty solid fundamentals and strong balance sheet. So when the market do suffer from flow position selling and this stock got trade down, it will be the opportunity to add these quality betas potentially in the next 3 to 6 months.
Winnie, thank you so much. Out of Singapore today. usually based out of Hong Kong, China equity strategist there at BofA Securities. Just on that note that Winnie was just pointing out here, Wired Magazine actually reporting this morning that this is something we should expect come Monday, that the Biden White House is expected to announce more measures on Monday aimed at further restraining China's ability to develop advanced chips. And what it means tangibly is that we could end up seeing around 200 Chinese firms added to this entity list. Right, from that, let's go to the Bank of Korea here, the rate decision out, more on the statement coming through that they will be looking at the impact of now back-to-back interest rate cuts out of the Bank of Korea. They've also lowered their inflation projection for next year. Plenty more ahead here on the China Show. Okay, here we go. Breaking news. The U.S. is readying more chip curbs on the China story that will stop short of early proposals. That's a headline crossing right now. So the U.S. will be adding over 100 firms to that entity list, including partners of Huawei. They'll be also imposing some restrictions around AI memory chips, and these new controls will not sanction CXMT, reversing some of the earlier plans. So there are lots of details there. We'll unpack our reporting a bit later on in the show, but suffice to say the question right now, Steve, will really be around, does this go further in limiting China's ability and the firms there key access to further their AI plans, particularly large language models here?
Yeah, I mean, I think it's something that we talked about a little bit yesterday with Samsung. They've been having some problems, obviously, with their HBM chips, high bandwidth memory, which, the next generation goes and helps those accelerators, AI accelerators at NVIDIA. So Micron has done really well there. SK Hynix has done really well. And I believe, David, from what you've just read there, these HBM chips and access to China will be included in this latest restrictions that we are reporting. All right, so shares of Chinese driverless tech firm, speaking of AI, Pony AI, slipped in their U.S. trading debut, erasing an early pop upwards. For more, let's bring in Bloomberg's tech reporter, Annabelle Drewlers. And you have a guest coming up. I mean, this is a company I've been covering for quite a while. I took a test drive in the Pony AI Toyota RoboCab in Beijing. Interesting technologies. A lot of people are trying to do it.
That's right. I mean, it's an extremely competitive environment just within China alone. And it's been an interesting moment because it's sort of rushed into the year end where you've got Pony AI listing. WeRide also just made its debut. Momenta's another. Deep Route just raised financing. So, yes, a very competitive environment internally, but also, of course, you've got those external pressures. And one of those is those rising geopolitical tensions. But joining us now is James Peng. He's co-founder and CEO of Pony AI. And James, thanks so much for joining us this evening. I want to kick off actually with what that breaking news just came through, because this is really an environment of rising tensions between the US and China. I know that so far you've been able to avoid those risks that are being posed by export controls on semiconductor and advanced computing technology, but how are you factoring them in to your business plans moving forward, given you've just got this huge cash that you've raised through the listing?
Yes. First and foremost, thanks for having us on the show. In terms of the sanctions on the chips, actually for us, it's nothing new. We have dealt with this for quite some time already. So for our strategy was and remains to be that we will diversify our supply chain. And I think as the more and more manufacturing of the chips coming out from either in China or rest of the world, we'll try to have more diversified supply chain to further de-risk our exposure to the geopolitical tensions.
Hi, James. This is Steve Engle here. We met, I believe, at the Beijing Auto Show earlier this year. And I did take a ride in one of your LiDAR and Pony AI-equipped Toyota robocabs in Beijing. I do understand that, you're a company that had some robo trials in the Bay Area, but also in multiple cities in China. So you kind of have, influence in both the United States and China, obviously. But what was the main questions as you took your company public in New York? What was the main concerns, if you will, of potential investors when you went on that roadshow in the United States with increased geopolitical tensions?
Surprising, actually, the geopolitical tension questions wasn't at the front and center of the investors, but rather the investors more focused on the economical side of the robotaxi. People are really interested in figuring out when will be a time for the robotaxi to be actually large-scale deployed and be profitable. So I think the good news is that people really believe in that 0 to 1 has already finished, and now it's the time for the autonomous driving companies to really go to the large scale commercialization.
What does that look like exactly, James? Because right now you're operational in 4 of the top or tier 1 cities, but what does that actually look like, say, over the coming 1 to 2 years? I know that you're going to continue to focus your efforts primarily in China, but talk to us about the competitive pressures that you face there as well.
Yes, especially if you're talking about the next 2 years, our main focus will be on the tier 1 cities of China, and actually just this year we also signed a deal with Beijing Auto and Guangzhou Auto to mass produce autonomous driving vehicles. So that means in the next 2 years, we'll have at least 3 models coming out of the assembly line will be launched into the tier 1 cities in China. So I think with the support of further support of the regulations, and the residents actually get more familiar with our services, I think we'll have a much larger fleet, have a bigger coverage, and hopefully we'll be able to actually have a much larger scale commercialization.
So, James, how much benefit is the ground truth data, so-called ground truth data, that you are collecting in China and all the domestic EV makers that want a part of autonomy? How much of an advantage does that give you over the potential arrival of full self-driving, FSD, by Tesla into the China market, perhaps by as early as the first quarter of next year?
Yeah, I think it's not too much about the ground truth per se. It's really about the technology that we can actually simulate a large-scale traffic data and being able to train our AI drivers in a diverse environment. Because driving itself is an interactive process. It's not really based on the human driving behavior alone. So actually, by using large-scale simulation model, by using the end-to-end model, we were able to overtake many of the other methods of autonomous driving and be able to provide much safer and efficient solutions.
James, it's clear that there's quite significant support from not just local governments, but also from Beijing in China as well. I'm curious because I was just reading through your prospectus earlier this morning, the filing you made to U.S. regulators, but essentially you said that China authorities have significant oversight and discretion over the conduct of our business and may intervene with or influence our operations as they deem appropriate. I'm wondering if that also came into any of the conversations, and if you could just give more context on that to our international audience.
Yes, of course. As I said, I think most of the investors took this as more like on the positive side, because essentially mobility and transportation as a whole is a highly regulated industry. I think having the government although you can see on one hand it's a heavy hand, but on the other hand it's a supporting hand. So I think having the local authorities together with the national relevant departments actually having a clear rule for the autonomous driving industry, it's helping the whole industry to be more mature. So I think most of the investors actually took this as a positive sign. Means that government actually took this as a maturing industry instead of just something that we need to be acted against. So I think overall having the government at the backing is a good sign.
James, let's talk about the U.S. market and the potential there. As you have listed in the United States, there were stories that maybe Uber Technologies would have invested into your IPO. What kind of talks are you having with companies in America that might want to partner with you and your technology at a time when, of course, Detroit and the major legacy automakers are struggling with their EV outlooks, while Tesla is trying to push theirs? And we all know that Donald Trump and Elon Musk are best buddies now, right?
Yeah, sure. Because, I mean, there's markets outside of China and the U.S. So there's a big slice of the pie outside of these two big markets. We are actually, over the last year or two, we started launching our services and having local partners in some of the global markets, such as South Korea, Singapore, Middle East, Luxembourg, and in some of those markets, I think the local partners or even the U.S. partners, as you just mentioned, Uber, could be a good collaborators to us.
James, just briefly, because we've got 1 minute to the end of the break, there is the risk that the US bans this type of software, autonomous driving software in the US. Do you see that presenting a challenge to you?
Not really, because we actually already start limiting our offerings in the US, although we still have R&D efforts. But as I already mentioned, we are actually more branching into the international markets outside of China, US and China. So I think the even banning our services in the US will not have a significant impact to us.
James Peng, co-founder and CEO of Pony AI. Thank you for joining us. And of course, thanks to our tech reporter, Annabelle Jewelers. Dave?
Yeah, interesting from James Peng. We'll be having James Peng coming on in the next hour, of course, and a separate conversation on fixed income. And the reason I say that, when you look at these markets, James from JPMorgan, who'll be joining us in a few minutes, his top calls are go long Asia rates, Malaysia, Thailand, Korea, China. Why? The offset that he is expecting that we did get out of Korea a couple of minutes ago that will boost those parts of the market given the tariff threat out there and given all the curbs we've seen so far in the last hour or so. So we'll continue the conversation. The second hour of the China show is just ahead. Good morning from the Asia Pacific. Good Thursday morning. So just some context really into how busy the last 2 hours have been here. So almost everything that we've got planned for the show got thrown out the window. So we're making things as we go along. We're not making things up. We're effectively just jumping on the next hoop. So a couple of things. You have a surprise rate cut out of the Bank of Korea, number one. Number two is we now understand the timing the new chip curbs coming through out of the Biden White House and an expanded list that might cover more Chinese firms. That's number two. So equity markets in the region are either flat or slightly lower, like the Hang Seng Index, and gone were the tailwinds coming through out of speculation yesterday that an earlier Central Economic Work Conference would be in the offing. Could still come. We don't know. But certainly the price action has gone away. Dollar China, big swings here. On the back of, well, number one, a stronger fixing, and number two, again, the chip curb story. Keep in mind, though, yesterday, quite a sizable range on dollar onshore. This is dollar offshore, as you can see, the fix. And then the dip into the last couple of minutes or so. We've given back a little bit right now, retraced slightly higher. So on net, we're trading at about 724.71. Okay, let's have a look at where we are in the dollar story, too. So we had inflation numbers coming in. No nasty surprise, leaving that sort of open question mark on the U.S. dollar. As far as the rate conversation goes in the U.S. and this preferred inflation gauge picked up in October, can we scroll, please, through the teleprompter? I'm just going to ad-lib this through. Thank you so much. 75 basis points of cuts priced from the current level into the end of next year. So this might include, well, this does include any rate cut we'll get in December, plus 2 or 3 more maybe going into next year. We know about the dollar strength, 8 straight weeks of gains on the dollar index, the Bloomberg gauges as well. This is the JPM currency index. This is a live spot. And as you can see, this acceleration in declines over the last 2 months or so. I think we're down 3% in October, a further 3% on this measure in November so far. And it takes us into the EM story currently of the, if you won, you lose, you put it that way. The won is down against everything today, all of its peers, after the BOK cut interest rates, I would say unexpectedly as far as timing goes, but certainly most of the economists that didn't get this one right currently were expecting some easing anyway, but this is now back-to-back cuts out of the Bank of Korea. Now, our next guest, in fact, almost called this. In fact, called this, they're making money from this trade. The trade tariffs and the uncertainty ahead will lead to an offset in domestic policy to shield these economies from any headwinds. Jason, joining us here on set is Jason Peng, Asia FX Rates and Portfolio Manager at JPMorgan Asset Management. Congratulations, you guys called this.
Oh, thank you very much, David. Thank you.
Yeah, okay, so talk us through how you're thinking about next year, what next year looks like, because the Bank of Korea gave us a preview of perhaps what to expect.
So I think the way that we've been approaching all of this is I'd like to think that we are more experienced investors compared to 2018 when we had the first trade tensions and so-called tariff escalations and all of those things. So I think when we are modeling all of this and thinking about the future of 2025, I'd like to think, as I said, we're more experienced. As such, then, the way that we've been positioning ourselves has actually been a bit more on the overweight side in terms of most Asian duration. And of course, this includes Korea. I think I've had to sort of just give you a more thematic outlook of what we're thinking is we will expect more uncertainty on export and trade going forward. So Asia, as you know, are mostly trade-oriented economies. For those countries with stronger domestic demand, we expect them to outperform from a macroeconomic perspective. But of course, those with weaker domestic demand, which I think, depending on how people interpret it, but I guess the Wall Street side does think that, domestic demand in Korea has been a bit on the weaker side, then naturally these central banks may need to ease further. Even if the Fed, for example, stays on hold. We actually think that the playbook may end up being a bit like China's 2018, where rates can go lower. Of course, the interest rate differential will have to be compensated by FX. But it doesn't mean that as an investor you can't make money out of this, if that makes sense.
So what does the Bank of Korea's move today tell you about the preemptive nature of other central banks, and where would you likely see that kind of action? And again, the currency weakness that would come from that.
Yes, so it's true, Stephen, that we don't necessarily feel that currency is the main trade for next year. And of course, then, for what it's worth in terms of this BOK surprise cuts, we are, making money from it. We're generating good alpha. We are overweight as a starting point. But I would also mention that, we are overweight across, other parts of ASEAN, particularly the low yielders such as Thailand and Malaysia. Even though we acknowledge that there's been a decent move in Korea rates today, it's worth to point out that actually Thailand and Malaysia have actually been slowly grinding lower as well. Now, of course, I'm not saying that they're going to cut immediately, but if you shock the external side, I think Thailand may actually have more room to ease further from here. So again, I'm not penciling any massive cuts per se, but if you get a tariff rest of the world 20 to even 25%, I think 50 basis points of easing is quite reasonable for some of these countries to insulate against the external shock.
Can we take your same thesis and apply that to China? And the 10-year, say, for example, on the CGB is at, let's call it just above 2% right now.
I think on a structural basis, we have been overweight China rates for quite a number of years by now, over a longer term. So we've continued to, I guess, progressively make money every year in the China strategy piece. I think at this juncture, as we all know, CGB yields are much lower than before. Having said that, we do expect still a degree of monetary easing via 7-day repo rate cuts or something else, or more fiscal easing. And I think all of this will gradually lead towards a lower interest rate environment for China as well, particularly if the tariffs pick up more asymmetrically next year.
How do you see this with corporates in China as they go to the market with their bond sales? Technology companies have one, that's a positive sign, but is this going to increase?
So tech companies have, as you know, been issuing convertible bonds due to cheap funding. And even on the credit side, as you know, recently there's been some big splashes on issues, and I believe you guys covered some of those companies. So putting it this way, the funding is cheap if you think about it from a spread perspective. These companies are able to issue sub 100 basis point spread, for a very long period of time. And then they can micromanage the U.S. Treasury rates funding, and hence, they're just issuing at very cheap levels. So I think it makes natural sense for them to do so. As Asian investors, for us, I think we are more welcome in terms of these developments because, as you know, the Jackie market cap index has actually been progressively shrinking due to less issuance. So when you're issuing in such size, of course, it's tight spreads, right? But as a market cap index inclusion perspective, these is all actually positive for the investment universe. So that's how we've been thinking of it. Yes.
Are they? It makes sense from an issuer perspective. Obviously, for everyone in the market, it's a good thing because let's say the overall universe improves. But if I'm looking to buy into this, though, what do you think of the valuations?
Valuations are tight.
Okay.
So I think even for us, when we approach all of these recent tech issuances, it's a bit more selective, to be honest.
Okay.
We don't necessarily see the need to buy everything there, but whereas, as you probably know, India has had some corporate headlines recently. We think of value creation there, and I think for names that we particularly like or do not see massive issues, some of them did cheapen up by 70 to 120 basis points depending on tenor. So I think even though we acknowledge that the China side of spreads are tight, there's not much going on, and we're not necessarily big buyers of it. We've acknowledged that there's also value creation in other sectors or countries where we've been actually deploying capital in those segments.
What's your view on Japan? I'm not sure if you are ex-Japan, but Japan is definitely in focus right now as they're in a divergent path of rates.
Yeah, I'm not exactly the full expert on Japan, so I think I can just mention a few quick highlights. And it's the fact that within our own teams overall, there is a more structural bias to be more constructive on the yen due to sort of the fundamental recovery that we've seen. And I think traditionally, as you can see in the overnight session, in the case of Latin American currencies, there was a big correction, which also led to the yen to rally quite substantially. So if anything this year, what we've seen is actually the reversal of carry trade. And I think then, because of that and because of the overall bias of a gradually or incrementally decent macroeconomics for Japan, I think all of this can lead to, over time, a more decent yen performance. So I'd say that the quick take is, at least for me, I have a bias to play it more on the long side, certainly not on the short side.
Just to end on the macro question here, everything is almost benchmarked to the 10-year in the U.S. Is there anything on the horizon that you think might lead to a material melt-up in U.S. Treasury yields?
So I think there is geopolitical tension, and you saw some of the headlines that you guys covered earlier in the day on the semiconductor side. I think those challenges and tensions will remain. I put it this way. So let's say December FOMC, right? All eyes on NFP. You get a weak print, the Fed will cut. Now, as you move into inauguration next year in January, I guess the question then becomes, well, what kind of tariffs are being layered upon? How much is being layered upon? And I think that's what is being debated on the street right now. Now, if you're layering on the higher side, then I think what we should be expecting is actually, a more on-hold bias. So if that's the case, you have to decompress maybe 25 to 50 points cut of the easing that you price in currently. That may imply maybe 25 basis points higher in U.S. Treasury 10-year from now.
James, thanks for joining us here in studio. James Peng of JPMorgan Asset Management. Now looking at
Jason Peng.
What did I say?
James.
I said James.
I made the same mistake earlier on.
What's on the teleprompter? No.
Yeah, well, I can't read. I'm dyslexic. But anyway, Jason.
Jason Peng, JPMorgan.
JP.
Apologies. Thanks for pointing that out, Dave. Look at Asian chip stocks now with our reporting that the Biden administration is considering additional restrictions on sales of semiconductor equipment and AI memory chips to China while stopping short of some stricter measures previously considered. I'm not going to get her name wrong. Let's bring in Debbie Wu, who leads our North Asia tech coverage. So, Debbie, how should we be reading this? This is a complicated story. It's clearly an escalation of the export controls in high tech. But also, there's a caveat in the lead to this story, and that is it doesn't go as far as previously reported. How do we rationalize these contradicting moves?
So I think there's some nuances in here. We are seeing that the Biden administration is weighing additional measures to China's access to chip equipment and then AI memory chips. But at the same time, some of its previous considerations, including saying sanction some of Huawei suppliers. So clearly, the number of plants run by Huawei's production partners make it's going to be smaller than previous considered. So previously we reported that there's going to be a 6 suppliers sanction, but now it looks like the Biden administration is going to sanction 2. So I think the administration looks like it's still grappling with how to strike a balance between really sanctioning Chinese chip makers that poses threats to U.S. national security while really not hurting Chinese consumer electronics providers that's really focused on supplying electronics to the domestic market. So I think that's where the nuances are coming from. And then we are now seeing, because of the lesser measures than previously expected, that Japanese equipment and then component suppliers, their shares are jumping because of this.
Yeah, Debbie, I'm glad you brought that up, because do we have a better idea? To your point, the market is bidding up some of these names in Tokyo and to a lesser extent, I guess, in South Korea. Do we have a better idea of who might end up being the sort of winners here, if and when we get this announcement?
I think winners is probably a bit of an exaggeration, but this is only a partial win for U.S. equipment makers, including Applied Materials and Lam Research, because they've been lobbying that if Washington or the Biden administration is insistent on unilateral measures to control China's access to U.S. equipment, then Chinese firms could just turn to their rivals, including Tokyo Electron and then Dutch equipment suppliers. And that way, while U.S. equipment suppliers may lose revenue, their foreign rivals will gain. So that's where the catches lie. And so we can consider that this is a partial win for U.S. equipment suppliers, but they are still going to lose more China sales when the newer measures come out.
Debbie Wu in Taipei for us there on this Bloomberg scoop that it's coming, and it's coming quite soon, this announcement. Right, we will leave you now with some live pictures out of the Bank of Korea live briefing, which is just starting at this point, in case you missed it, that they unexpectedly cut interest rates, announced that rate cut about an hour or so back, and in a couple of minutes we'll be joined by one of the 4 economists that actually got this one correctly. This is Bloomberg. Welcome back. So it's just 11:16 in the morning in Seoul right now. The BOK having this press briefing, unpacking that rate decision. They expected to, well, they cut interest rates somewhat earlier than most in the market had expected, although one of the economists who will be joining us, in fact, right now, predicted the move to happen today. One of the 4 joining us out of Singapore, Nomura's Jeong Park. Well, first, you got this one right, and congratulations on the call. What are you specifically looking to hear from the governor as we get this press briefing underway?
Yeah, I think Mark wants to know more about why the BOK suddenly cut the policy rate, because they had kept saying that they are concerned about housing prices, they are concerned about FX markets, and those concerns still with us. But even then, they just cut the policy rate. So markets would like to know that what is the true driver for today's decision. And beyond that, I think the market also interested in, the why the BOK is so, the pessimistic about growth forecast over the next 2 years. That's because of the mostly export, or that's because of the structural factors to weigh on the domestic economy. I think both can be the reason, but the markets would like to know more about the key driver for the BOK growth forecast.
So Jeong Wu, Steve Engle here. We're getting headlines from Governor Rhee saying it was not a unanimous decision. 2 members opposed today's rate decision. What does this, as well as the surprise move today, tell you about the path for future and perhaps more frequent cuts? Or is that it for this year? And what will be the first quarter look like next year?
First of all, it shouldn't be like a unanimous decision, because in October meeting, the BOK Doppler, the forward guidance, which suggests the policy rate, over the next 3 months. There was only one MPC member to forecast, the lower rates in November. So I think today's decision, I think there should be some dissenters voting against the rates cut. I think it's very natural. But having said that, we today we are seeing that the BOK, they can move if they have a concern of overgrowth. And the policy statement, I think, is very interesting. The policy statement, I think there are the 2 key changes to the policy statement today. First of all, the BOK just removed housing prices. The key factor, that drove the BOK hawkishness, but they just moved housing prices from the policy statement, as a policy reaction functions. And secondly, the BOK also, removed, the trade-off. Previously, the BOK always said that, like, the lower rates, it can have negative impact on financial stability, like, lower rates can push up housing prices. So because of that, there is like growth and financial stability trade-off. That was a very big constraint on the BOK monetary policy. But today, they just moved those 2 factors. So I think even if we saw, the dissenters, two dissenters, it's quite big. But in terms of the direction, I think the BOK will continue to cut the policy rate until they see it's done.
Okay, so we talked about timing, direction. I want to ask you as a final question on magnitude. It's one thing that they've brought forward the cut that was going to happen anyway. It might be another thing if they'll still go as deep as we expect. How low do you think the repo rate gets out of the Bank of Korea in this current cycle?
Yeah, if you look at the inflation forecast next year, it's 1.9%. So I think the BOK can easily get down to 2.5 next year. So, but the still 2.5 policy rate is still, I think, it's a slightly tightening area. So I think they eventually should go down to 2.25% next year.
Thank you so much for taking the time and joining us last minute. Jeong Wu Park there, Nomura Korea, also covers Taiwan economist there on, well, yeah, what made them call what they did and what the BOK did. Okay, just to recap some of the lines which have come through so far out of this ongoing press briefing. It was, well, 2 members did oppose the rate cut today, and that the Bank of Korea, of course, will continue to monitor and also work with the government to manage any volatility that arises because of this as well. Today's decision was as tough as any. Plenty more ahead. This is Bloomberg.
And welcome back. We are seeing live pictures of the Bank of Korea's Governor Lee talking about the surprise rate cut. Back-to-back rate cuts from the Bank of Korea. That was a very surprise move, 25 basis points from 3.25% to 3%. Governor Lee is talking about the red sweep in the United States exceeded expectations. And in the statement from the Bank of Korea, essentially saying that Korea's export growth likely to weaken under protectionism. So again, perhaps a preemptive move ahead of increased tariffs from the incoming Trump administration. And it was a difficult decision by the Board of Governors there in Seoul, as 2 members dissented and voted against the move today. Dave?
Yeah, in fact, Steve, I'm glad you brought that up, because on that note that this was preemptive, they've now come up, their models, with a specific number on how much future growth this actually creates, this move today. Which was, I think, the other point that he was making. It was not unanimous. It was as tough a decision as any. So it adds 0.07 percentage points to GDP growth. And I now wonder whether that's part of this new revised forecast on growth that they've also come out with, from 2.1 to 1.9%. In any case, of course, I think we're just obsessing too much over semantics. But the point being here is, certainly, we are feeling still the after effects of the U.S. election that took place, and policymakers are attuned to any potential fallout in their economies.
He's basically saying today's decision was as tough as any. And keep in mind, the Bank of Korea is remiss to do back-to-back cuts in their meetings unless there is an economic crisis of some sort. Does this equate to an economic crisis for an export-dependent economy? It's up for debate.
Yeah, well, a part of that, too, I guess to your point, wanting to stave off any potential future crisis ahead. And, a lot of central banks will be on notice because of what they did right now. And might every meeting, not just in Korea, be live, except Japan, to the point of Mark Cranfield, live from here on, going into the rest of the next couple of months or so. We'll leave this here for now. The won is down against everything else. A couple of quick movers to tell you about. E-commerce stocks in China are up on the back of some news here. I think this is a Xinhua report that they're looking to boost, well, first, ease export procedures and also some of the log jams and the cost there at some of the ports. That's number one. Number two is SAIC and some of the car makers like BYD, and the report yesterday that we've seen do indicate that they are pushing their suppliers to accept more price cuts from next year. So an indication of the price war and where that continues into 2025. All right, it's time for lunch as we head into the lunch break over in Tokyo. If not already, some people tend to get ahead of the crowd as well. So if you're in elevators joining us right now, where most of our viewers are actually situated, hello and welcome to the show. The Japanese currency is actually on track for the best week going back, I think, 4 or 5 weeks. Anyway, 156 north of that to right now, we're closer to 151 dollar yen. Let's hope this equity markets breaks out of its range soon. I mean, certainly Japan has really been one of the top picks from the conversations we've had recently as one of the best hedges against all these tariffs taking place. So hopefully at some point this market zones out of zone 2, if you get my analogy right. It's been stuck at this range for quite a while or so. Asia ex Japan, we're looking at the Asia Pacific down about 0.1%. S&P futures are steadying following the drop that we had overnight. I mean, I would imagine going into Thanksgiving as well and going into the rest of the weekend, we're looking at when we might get this announcement on chip curbs and what happens with the Microsoft story too. So volumes are actually quite thin as we approach, of course, the longer weekend, truncated trading sessions in America. Right, back to the China story. We have 2 briefings to look ahead to today. These are regular briefings, of course, but then again, as markets crave for more information on what we could expect from policymakers, we have 2 foreign affairs and the Commerce Ministry, maybe Commerce Ministry on the back of some of the things that we've been talking about here, chip curbs and the like, might be worth paying attention to, Steve.
That's right. I mean, this is the regularly scheduled Commerce Ministry briefing, as well as the Ministry of Foreign Affairs. Are we going to hear anything about Dongjun as well? That story yesterday where the defense minister, who's only been in the job 11 months, has been put into an investigation into possible, malfeasance.
Yeah.
If I want to put it that way.
Misbehavior.
Yes.
According to the FT, I believe.
That's after Li Shangfu, the previous defense minister, lasted in the job only 7 months. And he also was investigated for crimes.
Yeah.
All right. Well, we're watching BYD after a leaked letter showed it's asking suppliers to accept price cuts next year amid stiff competition in the sector. The China Securities Journal is also reporting a similar move by SAIC. Let's bring in Bloomberg's Asia transport reporter Linda Liu. First of all, I guess another deeper price war. I mean, it's already been vicious. You know, profitability is nowhere in sight for a lot of these car makers. Where does this take the health of the auto sector in China?
Yeah, the reports was met by really fierce debate on social media because everybody is just watching this intensely to see if the price war is going to get worse next year. Now, this indication coming from BYD and SAIC asking their suppliers to further cut 10% shows that maybe they are hoping to launch another round of price cuts in the beginning of next year as competition doesn't seem to be letting up. And now consumer may be the only winner in this war because prices of cars now are so affordable in China, but suppliers, you have these car makers, they are all losing out on the margins.
And, you know, this is a story that's become already political because of, particularly globally, right? As, you know, these cheap cars, of course, make their way in many, many markets. How might this further exacerbate that conversation, particularly with the U.S. and Europe now looking to impose further tariffs, of course, because of what's taking place?
Yeah, I think these Chinese automakers really have to weigh up, you know, the moves that they launch in the domestic Chinese market with launching these really intense price wars that take the prices of their cars down to very, thin margin levels. That means that they really need to open up new overseas market where they can actually charge higher selling prices and hopefully make up for these margins they've lost in the home market. But then that's also running into these tariff actions from the EU as well as the US, where they allege that Chinese automakers have an unfair advantage due to receiving subsidies from the Chinese government. So these car makers are really stuck in a difficult place managing all of these tensions, as well as trying to keep market share through price cutting.
Right. Linda, thank you so much. Linda Liu there, our Asia transport reporter. She's been very busy. And given the interview we just did as well with Pony AI, which listed overnight, so we'll let her be. There we go. So speaking of the debut overnight, not the best day at school, first day, down about 8%. We did speak, though, with, as we were just talking about there, with the CEO and a co-founder about their plans for what they plan to do with the cash that they raised, their growth strategy, and how they're dealing and navigating these tensions between Washington and Beijing.
In terms of the sanctions on the chips, actually for us, it's nothing new. We have dealt with this for quite some time already. So for our strategy was and remains to be that we will diversify our supply chain. And I think as the more and more manufacturings of the chips coming out from either in China or rest of the world, we'll try to have more diversified supply chain to further de-risk our exposure to the geopolitical tensions.
Hi, James. This is Steve Engle here. We met, I believe, at the Beijing Auto Show earlier this year. And I did take a ride in one of your LiDAR and Pony AI-equipped Toyota robocabs in Beijing. I do understand that, you know, you're a company that had some robo trials in the Bay Area, but also in multiple cities in China. So you kind of have, influence in both the United States and China, obviously. But what was the main questions as you took your company public in New York? What was the main concerns, if you will, of potential investors when you went on that roadshow in the United States with increased geopolitical tensions?
Surprising, actually, the geopolitical tension questions wasn't at the front and center of the investors, but rather the investors more focused on the economical side of the robotaxi. People are really interested in figuring out when will be a time for the robotaxi to be actually large-scaled, deployed, and be profitable. So I think the good news is that people really believe in that 0 to 1 has already finished, and now it's the time for the autonomous driving companies to really go to the large-scale commercialization.
What does that look like exactly, James? Because right now you're operational in 4 of the top or tier 1 cities, but what does that actually look like, say, over the coming 1 to 2 years? I know that you're going to continue to focus your efforts primarily in China, but talk to us about the competitive pressures that you face there as well.
Yes, our especially if you're talking about the next 2 years, our main focus will be on the tier 1 cities of China, and actually just this year we also signed a deal with Beijing Auto and Guangzhou Auto to mass produce autonomous driving vehicles. So that means in the next 2 years, we'll have at least 3 models coming out of the assembly line will be launched into the tier 1 cities in China. So I think with the support of further support of the regulations, and the residents actually get more familiar with our services, I think we'll have a much larger fleet, have a bigger coverage, and hopefully we'll be able to actually have a much larger scale commercialization.
All right, some breaking news right now, and this BOK story is continuing to give us a lot to trade on. So apart from the surprise cuts and the non-unanimous decision, it looks like there's a decent part of the Monetary Policy Board that are still open to reducing rates even further over the next 3 months or so. So I guess good context here is you have 3 of the 6, and there's a tie, of course, then that's when the governor comes in. It's rare we see the BOK do back-to-back. It's perhaps even more rare that we might see another one on top of the back-to-back rate cuts. Steve, you've been covering this too as well. Does this tell us anything really about their outlook and how uncertain because of elections?
Yeah, absolutely. This shows how uncertain the outlook is, especially even Governor Lee talked about how they were taken by surprise by the red sweep in the United States. And then, of course, everyone's been headline surfing since then, as Donald Trump has talked about even more tariffs on top of what he's talked about on the campaign trail. So I think they were taken by surprise, and they've admitted that. They said this was a very difficult decision, as difficult as any, and it's showing that the board is a bit split as well on how dovish they should be into 2025.
Yeah, they're leaving the door open, and all options are on the table.
But they have to watch the currency as well. They can't go, let the currency weaken too far, right? So they're going to be
managing it,
perhaps in lockstep with the government a little bit to make sure to manage the currency fluctuations.
Yep, certainly. Okay, for more context on this story for our clients, TLIV, go on your Bloomberg terminals, commentary, analysis, and most importantly, given the nature of today's decision, context. This is Bloomberg.
And welcome back. You're watching The China Show. Here are some of the major corporate stories we are following here. Bloomberg has learned that SoftBank is looking to increase its stake in OpenAI by acquiring up to $1.5 billion in shares from the startup's employees. Sources say the Japanese company will make a tender offer for the stock, allowing OpenAI employees to cash in shares if they choose. SoftBank contributed $500 million to OpenAI's $6.6 billion fundraising round in October, but had pushed for a larger allocation at the time. Well, the U.S. Federal Trade Commission, or FTC, is investigating Uber over whether it violated consumer protection laws with its subscription service. Documents viewed by Bloomberg News showed the FTC is looking at the enrollment and cancellation aspects of the product. The Uber One service provides discounts on rides and delivery orders for an annual fee.
Okay, let's stay on transport. So we have an extra runway in Hong Kong today.
Yeah.
Literally, that's not symbolic for anything. So it starts operations at the airports, but it could take at least another year, though, for the hub to reach its full capacity. Let's bring in Danny Lee, a transport reporter who joins us here on set to talk us through. I mean, okay, runway 3, but is this a big deal? Why is it a big deal?
It's a big deal when you think about how cities, countries all want to grow. They pour billions of dollars into extra expansion, particularly out of airports, because they can help generate billions of dollars of economic growth. And so when you see Hong Kong, you see Singapore, Seoul and whatnot, all expanding and pouring in billions, this is all to set themselves up not just for regional competition, but for global competition. And today, yes, marks several years in the making, $18 billion spent. But what we have found is that despite all the money that's been poured in, all the anticipation, everyone's talking about how great this new runway is, they're not really going to be making much use of it. There's only going to be a 4% increase in takeoff and landing slots next year. So they're really not making much use at the moment.
Yeah, the new runway is like the other ones, long and flat, but not going to have as much traffic. So what does this mean for Cathay Pacific? And I loathe double-barreled questions, but the second part of that is very much tied to that. Why aren't the foreign carriers coming back?
So I think for Cathay Pacific at the moment, they've been trying to rebuild, and it's been difficult for them. They have had their own staffing issues. But we've got some good news from them that they are going to see themselves hit 100% of their pre-COVID flight capacity by January. That helps set themselves up to look to the future, look towards the third runway and take advantage of the additional capacity to expand over the next several years. But clearly they have a challenge of rebuilding and getting to that point. But then we see foreign carriers at the moment, and it's fascinating the fact we've got this third runway. There's not much appetite for long-haul foreign carriers to come into Hong Kong. And clearly this has an impact on Hong Kong, its attractability, and given its sluggish economic growth, there is that challenge where Russian airspace has been a big challenge for those coming from Europe, for example, and even more broadly from North America. So I think for Hong Kong, this is still a big moment for them, but clearly this almost has come at the wrong time.
Yeah.
Is that, I'm curious, for foreign carriers, is that an economic consideration? It's certainly a commercial consideration why they're not coming back in such a big way. I'm just curious what the conversation is there.
I think for the foreign carriers, clearly there is a cost component to this. Trying to be able to not necessarily just compete, but have a flight that is viable. Not just spending more money to go around and charging ticket prices which are not going to make them deliver the profit that they want. And clearly, if you can fly elsewhere, then they will do so.
Yeah.
And the whole hub status. I mean, Seoul has made improvements. Bangkok is making improvements. Others, while Hong Kong.
Even the mainland Chinese airports are as well. So there's a lot of competition out there.
Well, hopefully Cathay Pacific lowers their airfare soon.
Yeah, that's the first thing they're going to
do. Hoping.
We'll see.
You have a monopoly here. What are you talking about? All right. Love Cathay Pacific. Bloomberg's transport reporter Danny Lee, thanks so much for joining us. And you can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter. It's out every Thursday. That's today. Even on Thanksgiving, it's out today. You can sign up via Bloomberg.com/newsletters. Plenty more ahead. Time to get our turkey, Dave.
Yeah.
This is Bloomberg.
Oh, okay, we're back live. There we go. So the center of gravity across financial markets has really been in Seoul over the last 2 hours or so. And it's actually, so we're still within the regular sort of time frame this press briefing takes place, although it's really been busy as far as headlines go. So in case you're just joining us right now, let me just recap that very, very quickly. They cut interest rates. Very few expected that they would cut rates today. It was a split, so it was not unanimous. It was the toughest decision as according to the governor. And 3 out of the 6 members on the board are actually still open to further cuts within the next 3 months or so. And that the BOK has sufficient means and intent to deal with, and this is the other thing that Steve was pointing out earlier on, they will be working with the government and within the toolbox that they have to deal with some of the currency fluctuations that this certainly creates and has created so far. When you look at where the currency is, we're weaker by 1/3 of 1%, and we're weaker against virtually all of its peers, the Korean won here, Steve.
Yeah, that's right. We'll keep an eye on this one as far as into the next first quarter of 2025. If there's that dissenting 3-3, I guess, on the board saying that they're not averse to further cuts in the next 3 months.
Yeah.
All right, we are having a breaking news out of Australia. Australia's Labor government, Dave, is reviving plans to overhaul the Reserve Bank, including splitting its board in 2. This is as we're in last-minute talks with the Greens Party. The government is open, according to this Bloomberg story, to retaining the Treasurer's right to override RBA policy decisions, a power that has never been used, Dave, since the RBA was established in 1960. RBA reforms are among dozens of bills that the government is trying to pass through the Senate in the final 24 hours of sitting this year, ahead of a possible election next year. So seeing not much reaction right now on the Aussie. All right, renowned economist Roubini is warning that Donald Trump's agenda of tax cuts and tariffs is shaping up as a double-edged sword for the United States. The CEO of Roubini Macro Associates told us more about the potential impacts of Trump's plan on inflation and growth.
Some of the economic policies of Trump may lead to higher economic growth, being pro-business, keeping tax rates low, deregulating the economy. But unfortunately, many of the other policies are going to have an implication of higher inflation and lower economic growth. The first thing he has already announced is going to be tariff against Mexico, Canada, and China. And that's only the beginning. He has said we might have up to 20% tariff on all our trade partners, up to 60% against China. He wants to have massive deportation of people. In the last few years, the increase in migration has kept the lead on wage growth, has increased the labor supply, has increased economic growth. So definitely mass deportation is stagflationary. He wants not only to make all those tax cuts permanent, but he made other promises. No taxes on tips, on overtime, on Social Security, on income earned abroad, and so on and so on. It's estimated these things may add to the deficit by $8 trillion. Too much demand, inflationary. He might want to weaken the dollar. That's going to be inflationary. He may interfere with the independence of the Fed. Getting out of the Paris Accords is going to make climate change much worse, increase food prices and things of that sort.
It's interesting, Nouriel, a lot of things you just said are what a Bitcoiner would say as to why you should buy Bitcoin. There's now the Bitcoin ETFs. They're over $100 billion, clearly a big hit. There's talk that it could be a strategic reserve. You have gold in the portfolio. Is there anything that could move you to add Bitcoin to your ETF to help accomplish some of these goals?
You know, the Bitcoin is highly volatile. It can go up by 10% one day and down 10, 15% another day. If you want to have a stable store of value, you would not put Bitcoin into your portfolio. The kind of assets we're actually thinking about are all assets that do well when you have lower growth and you have higher inflation, whether it's tips, short-term treasuries. Gold is a hedge against inflation, debasement, de-dollarization, geopolitics, financial crisis, some exposure to ag commodities that are going to do well in a world of inflation and of climate change, and environmentally sustainable REITs. So it's a diversified portfolio of assets that historically have done well in these types of tail risk. I'm skeptical for a lot of reasons about cryptocurrencies and Bitcoin, because they're not currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. And if you want wealth preservation rather than high volatility, you want to stay away from those types of assets.
Okay, that was Roubini, of course, speaking with our colleagues, and of course one of them, Bloomberg intelligence analyst Eric Balchun is there in in New York for us. Okay, let's have a look at some movers crossing. Well, some of the movers are right now in these Chinese markets. We'll start things off here with, I think these are some of the logistics-related stocks in focus here. Well, a couple of lines coming through. This is, so you have some logistics stocks, some low-altitude economy stocks are on the up. This is after China says it will aim to increase financing support for the group as well. So if you want to attach a number to that, China is aiming to reduce the ratio of total social logistics costs to GDP 13.5% by 2027. That's the action plan. Let's change the page and have a look at some of the digital finance companies too that should be mostly on the up. This is also on the back of a development plan that's been put in place. The People's Bank of China and 6 other government agencies are vowing to crack down on illegal financing activities that are taking place, of course, in the digital space and the strengthening risk aversion. Some of these players, as you can see, are being bid up on the back of that conversation. Right, we'll leave you with a look at the Hang Seng Index going into the last hour of the morning session here, and we're now down 1%, down to 200 points, and we've effectively unwound the gains in the afternoon session yesterday, Steve.
Yeah, that's right. I mean, they lost a little momentum from that September stimulus. Will we get more from the Central Work Conference in Beijing? This is...